Bad credit business loans. Yes, they're out there. It's definitely possible to get them, but there are some things you should know about bad credit business loans. And in this training, we're going to dive in and talk about those things. We're going to dive in and talk about all the things you need to know to be able to actually secure loans for your business, even if you have credit issues. We're going to talk about the little talked about details that you really need to know about getting these kind of loans. We're going to talk about what you do need to know to not only successfully get these loans, but be able to get them at the best terms and the best rates. And at the end of this training, I'm even going to give you access to one of our guides that will give you 27 killer ways to be able to get money to grow your business. We got a lot to cover, so let's get started. Let's dive in. So last time when you were with us, we talked a lot about business credit. We talked about how to leverage it for higher credit limits, for easier approvals. We also talked about how to good payment history with the business credit reporting agencies helps you get higher scores. It makes it easier for you to get financing as well. And we also talked about by helping you with why higher business credit scores will help to eliminate a need for things like prepaying orders, handing over deposit, et cetera, et cetera. So again, the purpose of that training was to really help get you on the path to be able to get better access to financing. So let's talk about bad credit, and let's talk about how it can actually cause the problems of fund a business and how to overcome those issues. So first of all, personal credit absolutely can and will play a big part in your ability to get a loan. I talk a lot about business credit. I don't mean to ignore personal credit. I want to give you an alternative for your credit. Credit can be built for your business so your business can stand on its own. But look, I never want to lead you to believe that personal credit's not important. It's really important. It's going to be very important in the growth of your business because there's a lot of funding out there that you just can't get without credit checks and your credit being decent, if not good. So, you need to get good business credit. It's very important, but you also need to be working on improving your personal credit. And look, don't feel like you're alone if you have credit issues. The reality is that a lot of entrepreneurs do because we're risk takers. We take a lot of risks. And unfortunately, our credit profile oftentimes reflects that because we take risks and sometimes those risks don't pay out. And sometimes that comes to bite us and it ends up hurting our personal or even our business credit. John, thanks, buddy, for coming in from New Orleans. Again, please tell me where you're from. I always like to see where everybody's from. So make sure throughout today that you tell me where you're from so I can give you out a little shout out and a hello. So bad personal credit can make it very difficult to get business funding from traditional sources. And by traditional sources, I mean the big banks. We look at Bank of America, when we look at Chase, when we look at Wells Fargo, these big banks will not touch you if you have credit issues. It's almost impossible to get funding there. And it also is even more difficult to get funding from alternative funding sources as well. So how do you get funding if you have damaged personal credit? Well, that's exactly what we're going to talk about today. So if you're trying to fund your business, but you have bad credit, well, there's two things you need to do. First of all, you need to find a way to get the funding you need right now. That's what's important, right? We got to find the alternatives that you can get money right now, even with those credit issues. And you also need to work on building your business credit profile. What I like to say is if you don't really have a good lendable asset, then you need to create one. If you have damaged personal credit, then it's even more important that you build business credit. Because what happens here is you say to a credit issuer, a lender, hey, look, I know I made mistakes in the past and I'm working through that. But look, my business has it. My business pays its bills. It's responsible. It's paying things on time. It's established its own credit profile and score. And when you do that, then it doesn't completely take away from the fact that you have personal credit, but it definitely outweighs it. So let's look, for example, at FICO's small business score, the SBSS score. The way the FICO small business score works is it takes into account consumer and commercial credit, a pretty scary thing if you have damaged consumer credit. But if you look at how that score actually works, in most cases, it takes in your business credit scores into account first. So it looks at your Dun & Bradstreet, your Equifax, your Experian commercial credit, and that's how it calculates a lot of the score. Then it looks secondary at your personal credit profiles and scores and takes that into the score credit. But here's the nice thing. If you have really good business credit with the three reporting agencies, it goes a long way to trump and overcome the consumer credit issues. You can still have a really good FICO small business score, even if you have damaged personal credit. That's exactly the way to look at this, is that if you have damaged personal credit, you need to build business credit because the building of business credit and the establishment of business credit and having good business credit won't completely outweigh and overcome the fact that you have consumer credit issues, but it will in large part make a very big difference in helping you still get credit financing at good terms, because it's a compensating factor. It's something where you're showing lenders or credit issuers that your business has the ability to pay its business bills, and it helps you overcome those consumer credit issues. So established businesses have options that newer businesses don't, obviously, when it comes to financing, because you already have cash flow. And the way I refer to this is something called the 3 C's, right? The 3 C's cash acquisition formula. And I just teach it this way because it's just super simple. As from a business owner's perspective, if you just know that lenders are always looking at one of 3 things, it's really easy for you to look at your business and get an idea of what kind of funding you can get. And those 3 things are credit, cash flow, and collateral. Well, we know our credit's damaged, or we wouldn't be here talking right now, right? So if the credit's damaged, that's why we want to build business credit. The business credit will help will help us get past the fact that we have damaged personal credit. But we still have these other 2 C's to focus on: cash flow and collateral. Well, if you're a new business, you don't have cash flow yet. And that's one of the biggest, most important ways right now business owners get capital, is they rely on their cash flow. And because their cash flow is consistent, because money's going into the bank account, if the bank account's managed responsibly, there's a lot of lenders that want to lend us money. But as a new business, well, it's harder to get money because you don't yet have the cash flow. And in a lot of cases, you don't yet have collateral, because you might have stocks, bonds, 401ks, or IRAs on the personal side, but you probably don't have equipment or inventory or account receivables or a bunch of purchase orders that are coming in the door. You don't have that stuff yet as a newer business. So when we look at this 3 C's formula, cash flow, credit, collateral, if your credit's damaged and you're a newer business, well, it's a little bit tougher, because you don't have cash flow yet. You don't have collateral. And there's alternatives, and we're going to talk about that. But just know that as an established business, it's easier because you have cash flow and you start to accrue assets that can be used as collateral, which opens up those other 2 C's, the cash flow and the collateral arms, which help you actually qualify for a lot more financing that way. In Janesville, Wisconsin, Robert, thanks for tuning in. Rhonda, thanks for coming in from New Orleans. Rhonda, you should go out to lunch with John. John's awesome, and John's in New Orleans as well. I want to connect you to Coco. I miss you. Thank you for coming in from Facebook. It's good seeing you again. And if you're getting value, hit the like and subscribe. And again, always give me a shout out. Tell me where you're from. I always like to say hello. So cash flow financing is basically where you're using consistent cash flow to be able to get financing. And in a lot of cases, you only need to have about 6 months time in business to do this. Most sources want you to have 12 months. You can absolutely get in the door and get this kind of financing done if you only have 6 months worth of actual history. So again, the key here is to have consistent cash flow, that you're managing it wisely and responsible. So what lenders and credit issuers are going to want to look at is they're going to want to look at your bank statements. They're going to make sure you have more money going in the account than going out. That's positive cash flow. A positive bank balance, which means you have money at the end of the month in the bank account as well. They just want to see that you're managing the bank account responsibly. You're not overdrawing the account. You don't have non-sufficient funds. If you're managing the bank account responsibly, it opens up this door for cash flow financing, where you typically can get upwards of 10 or 15% financing against whatever your revenue is. So if you do $200,000 a year in revenue, you can usually get a loan for 15% of that, which in this example is about $30,000. Okay. So you're basically, with this kind of financing, borrowing from future cash flow. That's what you're really doing. What you're doing is you're selling your future cash flow at a discounted rate to an actual lender. It's not even considered to be a loan. It's actually considered to be that you're selling future revenue at a discounted rate to the lender. Okay. So that's what you're actually doing. But again, a really good way to go if you're investing the money into something that's going to increase future cash flow. Not a good way to go if you're just trying to fill a void to be able to get to future cash flow. Okay, so what I mean by that's if you're a seasonal business. So let me give you an example. One of my friends, Mark, which actually was my science teacher, like the best teachers I've ever had, he actually solicited me and said, "Hey, I'm looking for money. Can you help me?" And I said, "Sure, let me just talk about your business." He had a seasonal business. He needed money to get through the slow season. I didn't offer him cash flow financing, and I told him about it. I said, "This isn't a fit for you, because it's a fit if you're investing the money for growth, but not really for you to try to get through a slow season." Then I saw about weeks later that he posted something on Facebook that he'd been solicited for this. And he's like, "This is highway robbery. I'm getting charged all this interest for this product. This doesn't help my situation." So I give this as an example because this is not to get through a slower season. It's not. That's not what cash flow financing helps you do. What cash flow financing helps you do, if you're borrowing against future revenue, is if you're doing something now that will increase future revenue. So let's say, for example, I started running Facebook ads and it's looked pretty successful. I went from $5 a day to 50 a day to 100 a day. Okay. And now all of a sudden I'm getting leads at $5 per lead. I'm converting those leads and I'm getting a positive return on investment. For every dollar I spend on Facebook, I get $3 in return. Well, that would make sense to possibly get financing to do more of what you know is working. So then you know you can increase future revenue, or you have a pretty good shot. You've already tested it. You're taking a risk. The first time we ever got cash flow financing, we were doing three things. We were going to go execute three things that could drive more revenue. Now, two of those three didn't work for us. One of the three did. So we were able to borrow money and use it to invest in the business for growth, to grow our revenue. One of our three things worked. We were able to grow the revenue. We paid the financing back. So that's a perfect example of how cash flow financing can actually help you. Now, again, a lot of sources don't have a minimum credit score here. And the ones that do typically have about 500 credit scores requirements. So you can get approved really no matter how bad your credit may be, as long as you're not actively in bankruptcy or something to that effect where that could cause a problem, because then you could just write off the loan that you just got. But outside of that, there's a very good chance even with serious credit issues, you're able to get approved. All you really need is about 6 months worth of revenue. Now, another example of this is merchant cash advances. Now, merchant cash advances is very similar to cash flow financing. The biggest difference here is that cash flow financing looks at all money going into your bank account. We look at cash deposits, we look at checks, we look at credit card transactions as well, all that money that gets put in the bank account. Merchant cash advances, we only care about credit cards and what you process through credit cards. So this is simpler and easier than cash flow financing to get approved for. Matter of fact, in a lot of cases, lenders have no credit score requirements here. Instead of being in business 1 year, you only have to be in business about 6 months. Instead of having like $10,000 a month in revenue, which a lot of lenders want with cash flow financing, you only need about 5 months in revenue. And all they're really looking at is your bank accounts and your merchant account statements to make sure that, again, you're managing your bank accounts responsibly, and that you don't have a bunch of chargebacks and problems with your actual merchant account processing. Now, that being said, some of the biggest examples of this, the best ones, are Square, Stripe, and PayPal. Now, if you accept customers' payments through Square, Stripe, or PayPal, then it opens up a tremendous opportunity for you, because they will give you upwards of 30% of whatever you're processing through them advanced. They don't have credit score requirements. They oftentimes charge you a small flat fee instead of an interest rate. They take their payment back out of the payments that you're using to process them, or that you're processing through them. So if you are accepting payments through Square, Stripe, and PayPal, they often up some of the easiest cash flow financing options I've seen. If you're not, you need to. Part of your customers' payments should be accepted through Square, Stripe, or PayPal, because in doing so, a few months down the road, that's going to open up really good, easy funding opportunities for you. They really have phenomenal opportunities where you can borrow as much as $500,000 with some of them. I think PayPal's like $500,000. I think with Square, you're up to like 100 grand, but they continue to raise that. And people like Square, then they're really figuring it out. They just rolled out this month a banking product. So now you can get a banking account through Square, a checking account. You can get a savings account. You can get a debit card, and you can process payments and get loans. So again, they're making it easier and easier to be able to process your payments through them, and then be able to actually borrow against what you're doing in the future as you continue to grow your business. Now, a lot of other sources as well. If you're not using Square, PayPal, and Stripe, that's where majority of revenue lending and merchant cash advances are not PayPal, Square, and Stripe. But I'm using PayPal, Square, and Stripe as an example because that's on top of what I'm teaching here. And that's still another good alternative if you are accepting payments through there. Now, another option is called invoice factoring. And with invoice factoring, this gives you a couple opportunities. First of all, you need to let your customers pay you on terms. So if I'm selling something, like here at Credit Suite, we have a business finance suite. And our business finance suite, it goes through with advisors and a finance team and our technology where you can improve your fundability, build your business credit, access credit monitoring, financing for your business. Everything you need to get money for your business is part of this. Well, it's about $3,000. Okay. And we have, other programs where you can offer it as a service. Well, we have our customers, we allow our customers opportunity to pay over terms, 7 months. That's called a receivable. So what that means is it means you're agreeing to buy our enrollment for X amount of dollars, and you're going to pay Y amount per month every month until you pay that X amount of dollars. That's called a receivable. Okay. You now owe the company money because you bought something you're going to pay on terms. Well, this is called invoice factoring. Invoice factoring gives you the ability to borrow against whatever that future amount that you're going to collect is and get it upwards of 90% of that money advanced to you in 24 hours. So let's just do some simple math. Let's say that you borrow something for $1,000. You're buying something for $1,000. Let's say they let you pay it over, 4 months term, which is $250 is what they owe you. They're going to pay you over 4 months, $250. Okay. And actually, I don't know if I'm using you. And I just got confused when I'm using you and as an example here or then. So let's use you as an example. So you're buying something for $1,000 and you agree to pay $250 over 4 payments for that. Well, what happens in that case is a factor would then look at that money that's owed and give you as much as 90% of that within the next 24 hours. So the business owner would actually get up to 90% of that amount that's owed, in this case, $900 of the $1,000 the next day to the business owner. And then the actual lender collects from the actual customer. So this gives you the ability to let your customers pay you on terms. And when you can let them pay you over time, well, then that means that you have more customers because it's easier for them to pay you. The ones that don't have the money to pay that full $1,000 up front can pay over time and you attract more customers. The nice thing to you is that you can still get majority of that money, 90% advanced to you right away the next day, not have to wait months for those invoices to actually get paid. That's what invoice factoring is. And it's really got dual benefit. First benefit is that it actually can help you get more customers because your customers can pay you on terms. The secondary benefit is that you can borrow against those receivables, get up to 90% of that money in a very short period of time with like 2% factor rates, very low rates. And credit isn't even a factor here. Your personal credit doesn't even matter. So when we talk about this kind of AR financing or invoice factoring, it's all the same. It's called AR financing, account receivable financing, account receivable factoring. Okay, this all exactly the same thing. That's exactly how it works. Now, when we also talk about this, we talk about options for bad credit business loans for new businesses. Well, then there's options there as well. If you have collateral, then there's a lot of ways you're able to get financing. 401k, stocks, bonds, IRAs, to be able to get what you need. Okay, you also can come in here and you're also able to build business credit. You're able to get financing through alternative lenders. You're also able to use guarantors as well. So there's a lot of other options that can work for you. So let's talk about business lines of credit. So there's definitely lines of credit that can work for you if you have credit issues. My two favorite, really, I've got one real favorite. And you can go to creditsuite.com/fundbox to get access to this. Fundbox, FUNDBOX. So creditsuite.com/fundbox is a fantastic credit line. You can get up to 150 grand. It's not based on personal credit scores. It's based on just how you manage your bank account. If you've been open for 6 months, you're managing your bank account responsibly, there's a good chance you can go through this program. You can get an immediate approval, usually less than 10 grand. If you supply tax returns, you can get upwards of 30 grand. And again, if you use the credit line and then solicit them for more money, it gets bumped. We got 6 grand, supply tax returns, bumped to 30, used the credit line, applied again, or solicited them for more money, they bumped this to 100. Okay, and we see a lot of clients get approved for this when they can't get other kind of funding. And it's called creditsuite.com/fundbox, so a company Fundbox. Now, there's also a company called Bluevine that does something similar, but Bluevine's underwriting requirements are a little bit more stringent. For every 5 people I send to Fundbox to get approved, maybe one of them could go to Bluevine to get approved. So that's one of the best lines of credit that I think can help you. Now, the Credit Line Hybrid is another program you want to look at. Now, this is completely based on you having good personal credit. So why am I talking to you about it? Well, because half of the people we help with this program end up using a guarantor, a family member, a friend, a potential investor. They're using somebody else's credit to qualify. So let me give you an example. And I use the same one because it's a real example in my life. If I'm going to go to my dad to start a business and I say, Dad, I need 25 grand to do so, my dad would do that for me because he knows that I will pay him back. Okay. And he also believes in my ability to run a business. It's something I'm really good at, and he knows that. Okay. So that being said, if I did that, my dad would go sell his stocks, would pay penalties, would lose the interest to give me that 25 grand. But I could go to my dad and say, Dad, I need 25 grand to get a business off the ground. Here's what I want to do. I want to get this program called Credit Line Hybrid. My credit, I've got some issues that I need to work through and I'm fixing. But if I could use your credit to sign to get me these credit lines, I can get up to $150,000. I can get 0% rates. These accounts, I can even get ones that report to the business credit reporting agency, so they help me build my business credit and don't report on your consumer credit. If I have that conversation, it's easier for Dad to let me do that then give me the 25 grand and pay penalties and not earn interest. Because all that happens is he's letting me use his credit to do it, the accounts report on my business credit report, so it doesn't damage his personal credit. And the only way he loses out is if I default, don't pay the credit lines, then they report his collections. That's a problem, right? But guess what? If I borrowed 25 grand from him and blew it all and didn't pay him back, he was hurting that way anyways. So either way, he gets hurt if I don't pay him back. So again, this opens up an opportunity to go to family, friends, and investors and rely on them to help you actually sign as a guarantor to get financing. Now, with Credit Line Hybrid, you can get 0% rates for up to 18 months. You can get it as a startup, as a nonprofit, as a high-risk industry. Okay, you're also able to come in and get approved even if you have no cash flow, even if you have no collateral, it's unsecured. It's no doc. They don't need bank statements, tax returns, a lot of the stuff that gets you denied. All you really need is you just need to be able to come in and have a good credit, about 680 FICO score or higher, or somebody else that does. And you can usually get as much to 5 to 8 times the amount of your highest credit limit account you have now, up to about 150 grand. Now, let's also not forget about family and friends. And don't get me wrong, I'm not saying to go bum money from family and friends. It's actually quite the opposite with what I'm about to show you. So when we look at this, what we see is that 75% of business owners get money initially from business owners, or to start a business, from family and friends. Okay, so when we look at family and friends, this is often the bucket that's relied on most for business owners to get money. But here, I want to give you some creative ways to do this, because you don't have to go to family and friends to try to bum money. Okay, I don't want to do that. I'm sure you don't want to do that either. I don't know. I found some people are okay asking for money, and that's natural for them. I'm not. I'm a homeless on the street, no place to live before I ask for help kind of guy. I think we're all different there. But the bottom line is the vast majority, 75% of business owners are getting money from family and friends. But there's other ways to do that. They could sign as a guarantor. The other thing they could do is they let me use their assets as leverage to get financing, stocks, bonds, 401ks, or IRAs. And again, I'm going to go back to my dad as an example. If I go back to my dad and say, give me 25 grand, he sells the stocks, incurs penalties, doesn't earn interest, and gives me the 25. But I can also go to my dad and say, I need 25 grand to get a business off the ground. I have a proposal. You have stocks in the stock market, IRAs, et cetera, right? Yeah. Well, I'd like to leverage that to get me a $25,000 credit line. I get a 5% interest rate credit line. Okay. And you still earn interest on the stocks and bonds. So you're still earning interest on the stocks and bonds. You don't need to sell them and pay all kinds of penalties. And then I still am leveraging those stocks and bonds to get a credit line to grow the business. And then in that case, I might even give them equity ownership in the business. I might give them an interest rate on what I'm borrowing. Okay, now my parents won't let me do that. My parents are the ones that taught me to charge interest. My dad's the one that said, hey, when you go in the military, everybody's going to spend their money really quick, and then they're going to run out, keep your money, and then loan it to the other soldiers at a high interest rate. I mean, this is the kind of financing, this is the kind of training that you get from a father who's an accountant, his world in the financial space. They won't let me give them interest on if I ever borrow money, and I rarely have done that in my life. Okay, and that's probably why. But what I am saying is that if I go to a friend and say, I got this killer business endeavor, it looks like it's going to be a home run. Do you want to be part? And they're like, I work a full-time job. I can't. I don't need you to. Here's what I want you to do. Leverage your stocks and bonds. Help me get the credit line to get 25 grand in funding. I'll give you 5% ownership of the business. I'll give you 10% ownership of the business. I'll pay you 10% on the money that I borrow. So it's not like you're asking for a handout here. What it is you're using the same path that 75% of entrepreneurs do, family and friends. And then all you're doing is giving them an easier way to get you access to money using their stocks, bonds, 401ks, or IRAs as leverage. You get a low interest rate credit line as low as 5%. And the nice thing is they only lose if you default and don't pay it. And again, they're still earning interest even on the stocks and bonds. So another example that you can rely on family and friends to help you through this as well. Now, that being said, also keep in mind that angel investing, which we're all familiar with, we don't even realize that the vast majority of angel investing is not coming from unaffiliated angels. When we think about angel investing, we think about a pitch deck and standing in front of, sharks and pitching them. That's not how most angel investing takes place. Most angel investing comes from people you know. It's people in your circle. It's your family and friends. So what's happening with angel investing is that you're actually not getting money from all these, people in Silicon Valley. What you're doing is you're actually getting money from family and friends. And a lot of outside angel investors are what we call unaffiliated angels because they're not affiliated with you. They want to see affiliated angels, i.e. people in your circle that are already invested, or they don't want to invest. They never want to be the first one in, because if you can't even get, your family and friends to put money in, then what does that say about you? Like if I go to my family and friends right now and say, I'm getting a business on the ground, I need to raise some capital. I'm telling you right now, a lot of people are going to front that capital because they know what I can do, especially if they can earn a rate of return. And I'm the same way. I invest in family and friends that I know who they are and I know they're going to kill it because I know I'll get a rate of return. So it's not a handout. It's actually a way for them to help you and then get a rate of return, whether it be interest or ownership equity in your company. So some things to consider. You don't have to give that up. I'm just saying, consider it. Kiva is another great way to do this. With Kiva, you can raise like $10,000 at 0%. They don't even charge you interest. But the key is they want you to have a handful of your own family or friends to invest as well. And they don't have to invest a lot of money. I think it's as little as $25 if I remember it right. But loans are crowdfunded in increments of $25. You can get in with as little as $25. You need at least a handful of friends to be able to contribute to your campaign. Because again, Kiva's like, I'm not going to give you money if people around you won't even give you money. But if so, you're able to come in and be able to get a $10,000 loan at 0% interest. So pretty creative way to do it. Now we talked about 401k financing. This is where you leverage you or somebody else's 401k. You can borrow as much as 100% of the value of the 401k based on IRS proven principles. So there's absolutely no tax penalties here. You can get the money in 3 weeks or less and get a credit line or a loan for only 5%, leveraging you or somebody else's 401k or IRA. Okay, it's basically a rollover. Now, on top of this, you also have stocks, bonds as well. As I mentioned, you can borrow as much as 90% of the value of stocks and bonds, still earn the interest, still get a rate of return on those. And again, you can borrow as much as 90% of the total value. I love that because in my mind, you're double dipping. I don't understand how it's even possible. It doesn't make sense to me. And here's what I mean by that. I have money in the stock market invested that's making my money. Now I can use my stock portfolio as leverage to get a credit line that I can invest into a business that's also making me money. So my money is literally working for me two ways. It's still in the stock market earning me interest, and then it's over here as well. Also now invested in a new business, which is getting me a rate of return. So stocks, bonds, 401ks, IRAs. Okay, and also let's talk about business credit. Look, if you have credit issues, especially if you're just starting a business, business credit is the answer because 85% of what you need to buy for a business is done through business credit. Think about it. Amazon, Walmart, Staples, Office Depot, Visa card, MasterCard, auto financing, computer leasing, it can all be done through business credit. So if you come in and build a credit profile and score for your business, then leverage that to get high limit credit cards. Most of what you need to buy to grow a business, you can use these credit cards for. Now, don't get me wrong. There's some stuff like payroll that you might not be able to, right? And payroll, you might have to actually go get other kind of financing or the business has to generate the revenue. But the vast majority of what you may buy and spend money on, you can actually use business credit to be able to get. And you can get it even if you have a damaged personal credit. You could build business credit from scratch, even if you have damaged personal credit. And again, even if a lender does check your personal credit by having established business credit, it's still a good chance that you're able to get approved that way. So look, business credit, bad personal credit doesn't have to be the end all. Okay, for you as a business owner. The reality is that there's three pillars that can get you money: cash flow, credit, or collateral. And any of those will work. We can use collateral from you or somebody else: stocks, bonds, 401ks, IRAs, account receivables, start accepting payments from our customers. Once we start generating cash flow, we can rely on that. Merchant cash advances, cash flow financing, PayPal, Square, Stripe type financing. A lot of options available there for us. Then we've got that third pillar, which is credit. We want to fix our personal credit. But if it's damaged, we also want to build business credit because that opens up a whole other funding asset as there. Starter vendors that will give you credit initially. Retailers like Amazon and Walmart who will give you credit even if you have none. And you can start building credit to get approved with them with your personal credit not even being looked at. Then we start looking at the other C, which, well, actually it is the other C. We talked about collateral. Okay, we also talked about cash flow, and the third C is credit. So we can build business credit while we're fixing the damaged personal credit, and that gives us the ability to be able to get money as well. So next time what we're going to do is we're going to talk about how to set up your business the right way to be able to build business credit. And you'll discover a lot of issues that you probably have right now that are preventing you from getting funding. Look, the vast majority of business owners are not denied financing because they don't qualify. They're denied because they have issues that are really easy to fix that they don't even know about. So we're going to talk about that, root that out to set you up for success with getting funding. And don't forget, if we can ever help you get funding, give us a call. If you give us a call, understand we'll help you get loans, credit lines. We don't charge you any money for that. We have a way that we help you get funding. We help connect you with the funding source, and you don't pay us a dime. We don't charge you interest rates. We don't charge you fees. Don't get me wrong. the lenders are going to charge you rates and fees. That's how lenders make money. But we even negotiate to get that lower for you. We'll help you all the way through the funding process, even to being able to qualify for SBA loans as well. So it's like having a free resource in your corner that helps you along the way. If you're interested in that, give us a call, a free consultation. On this consultation, 3 things happen. 1, we do a fundability assessment. We figure out what's wrong with your fundability that you need to fix to become more lendable. 2, we actually come in and we get your business credit reports with Dun & Bradstreet, Equifax, Experian for free. We go through those with you. We go through those with you and give you tips and tactics to be able to build your business credit. And 3, we help you do a funding assessment. We tell you all the loans and credit lines you can get right now. All that happens 100% for free. All you have to do is give us a call at 877-600-2487. That's 877-600-2487. And if you got value from this training, make sure you like and subscribe. And go to the top right of our page, creditsuite.com. We have daily tips on Instagram, Facebook, Twitter. We have thousands of videos on our YouTube channel. We have a podcast, the Business Credit Financing Show. We have all these experts come on and teach you every aspect you need to know to start a business, get it off the ground, and grow it to be successful. All of that can be accessed by our social media links at the top right of our page, creditsuite.com. So make sure that you check that out, because I think some really good stuff that you're going to be able to find when you're following us there. Now, Brilliant Davis says, hey, Ty, hey, Tucson, Arizona, thanks for coming in, man. CEO of Unbound Business Solutions. I like that name. That's awesome. John says, hey, I claimed bankruptcy in 2015, but I'm now up at a 725. Congratulations, man. And being an authorized user on my mom's account because she's at 825. That's perfect, too. We have a combined available credit of about 75 grand. Okay, here's the problem. With Credit Line Hybrid, they're going to look at the highest credit limit you have, not an authorized user. So keep that in mind. But everything else you said is good. Your credit's good. You should qualify. Just keep in mind, they're going to look for Credit Line Hybrid at your highest limit account, not somebody else's that you're an authorized user on. So that's it. Now, my mom co-signed for everything I asked. Well, I think, yeah, absolutely. She could absolutely co-sign for you as Credit Line Hybrid, and you could use her credit to qualify. I love that. Robert Shields, I love you, Robert. Thanks for coming in from LinkedIn, man. And FMCSA compliance specialist. I love that. How do you get loans against the stocks you own? Well, you can give us a call. We can help you with that. We can actually get you with a funding source that can do that. There are special funding sources in this country, and we had one come on and speak live during the funding challenge that will help you through that process. But it's very simple. All they're going to want is your statements that actually show your stocks. They go through from that point, regardless of credit, regardless of other collateral, regardless of cash flow. You can borrow as much as 90% of the value of the stocks and bonds and get an interest rate as low as 5%. The only real requirement is that they want you to have about 25,000 in stocks and bonds to be able to do that. And if you do have that, there's a good chance you can qualify. Give us a call. What we'll do is we'll get you with a funding source that can help you with that and help you get that done. And you're also saying, I understand the principle of borrowing against the stocks, but can you do a presentation on how to do it, the process of doing it? Well, it's nothing you do. You need a funder that does it. There are certain specified funders in the country that do this, and there are different ones depending on your situation. So if you give us a call, our funding team will say, okay, here's your situation. You want to go to this funder. We'll directly get you connected with them. We send a lot of business over for these kind of deals, so they'll even typically give you discounted rates and stuff like that. So we can help you with this. It's nothing you do. It's you go to a funding source and they give you a loan. The only difference is they're using your stocks as collateral. So it's not actually something to teach you the step-by-step process, because it's no process you need to do. You just need to talk to somebody that's the best fit for your individual situation to help you get financing. So you said you got the message. Great. And John says 7,500. I'm not sure, John, what that means, but if you post in some more context on that, I'll answer it, because I think you mean no, I don't. Okay. Anyways. So, John, if you have another question, just add more context to that comment. I can give you some feedback. So hopefully you enjoyed this training. Make sure you like and subscribe. We go live Tuesday and Thursday at 1 o'clock, 11 o'clock on Wednesday as well. And all of our trainings are all about helping you get capital to be able to grow your business. So I look forward to seeing you on our next training where we talk about how to set up your business the right way to be able to get financing. And DOT FMCSA compliance specialist, you're awesome. Thank you very much for coming in. So thanks for tuning in. Keep an eye out for our next training where we talk about more cool ways to get money to start and grow your business.